Assalamualaikum and hi, I'm Sabil. Now I'll explain about the liquidity ratio. Purpose of liquidity ratio is a firm's ability to meet its short-term financial obligations. That is whether the company has the resources to pay its creditors when payments are due. There are two types of ratios under the liquidity ratio, namely current ratio and quick ratio. Current ratio is a liquidity ratio that measures the company's ability to pay short-term obligations or those due within 1 year. The formula is current assets divided by current liabilities. So 4,400,000 divided by 2,200,000 and the answer is 2 times. Therefore, Bati Berhad's current ratio is lower than the industry average. In order to improve the current ratio, the company could increase its current assets by increasing the shareholder funds. Okay, quick ratio compare a company's most short-term assets to its most short-term liabilities to see if a company has enough cash to pay its immediate liabilities. The formula is current assets minus inventory minus prepaid expenses and divided by current liabilities. So 4,400,000 minus 1,210,000 minus 490,000 divided by 2,200,000 and the answer is 1.18 times. So Bati Berhad is able to meet its immediate possibilities because quick ratio is greater than the industry average. The company may enhance the collection duration or accounts receivable to improve the quick ratio. Next is efficiency ratios. The purpose is measure how effectively the firm is managing its asset in generating sales. There are 4 types of ratio under efficiency ratio, namely inventory turnover ratio, average collection period, current assets turnover, and total asset turnover ratio. Inventory turnover ratio indicates how many times the inventory is sold and replaced in 1 year. The formula is cost of goods sold divided by average of closing inventory. So 9,800,000 divided by 1,210,000 and the answer is 7.48 times. Therefore, Bati Berhad's inventory turnover ratio is higher than the industry average. The company could lower its purchase quantity to increase its inventory turnover ratio. Okay, average collection period indicates the number of days taken by a firm to collect its accounts receivable. The formula is accounts receivable divided by revenue divided between annual credit sales and 360 days. And after calculate, the answer is 40 days. Therefore, Bati Berhad is taking 40 days to recover receivables, which is greater than the industry average of 35 days. In order to improve average collection period, the company may give early payment discounts. Then, non-current assets turnover measures the firm's efficiency in utilizing its property, plant and equipment in generating sales. The formula is sales divided by net non-current assets. So, 70 million divided by 6,800,000 and the answer is 2.5 times. So, Bati Berhad has used its asset more than efficiently than the industry average since the ratio is greater at 2.5 times. In order to improve non-current asset turnover, income must be increased. Lastly is the total assets turnover ratio. It measures the ability of an organization to efficiently produce sales from assets. The formula is sales divided by total assets. So 70 million divided by 11,200,000 and the answer is 1.52 times. Therefore, Bati Berhad generates a lower sale using the provided assets with only 1.52 times. The company's efficiency should be improved in order to increase the total asset turnover. That's all from me. Thank you.
Hello, my name is Heidi. Next is leverage ratio. Leverage ratios measures the level of debt or borrowing in a firm. They tell us whether the company uses more debt financing to finance its asset and operation as compared to equity financing. Under leverage ratio, there are 3 types of ratios. The first one is debt ratio. Debt ratio is defined as the ratio of total debt to total asset expressed as a decimal or percentage. The debt ratio formula is total debt divided by total asset. So the debt ratio for this question is 2,200,000 plus 1,200,000 divided by 11,200,000 and times 100. The answer is 30.36%. The debt ratio of Bati Berhad is lower than the industry average, which is 30.36%, whereas the industry average is 40%. As a result, they have lesser borrowings in the sector. To improve debt ratio, companies can make proper management of inventory and increasing the company's sale. The second one is debt to equity ratio. The debt to equity ratio compares equity to debt and is calculated as total debt divided by total equity and times with 100. A high ratio indicates that the business owners may not be providing sufficient equity to fund a business. So the debt to equity ratio for this question is 2,200,000 plus 1,200,000 divided by 4 million plus 1,800,000 and times with 100. The answer is 58.62%. Bati Berhad relies more on stock and less on borrowings to fund its operation. As a result, the industry average debt is greater than the Hikmah Bati Berhad with 60%. To improve debt to equity ratio, the company could increase profitability, improve sales revenue and reduce costs to increase your company's profitability. The third one is time interest earned. Time interest earned measures the firm's ability to cover its interest charge out of its operating profit. The higher the ratio, the higher is the firm's ability to fulfill interest obligations. The formula for this ratio is earning before interest divided by interest earned. The times interest earned for this question is 2,400,000 divided by 360,000. The answer is 6.67%. With 6.67 time interest, Hikmah Bati Berhad outperforms the industry average. If they fail to satisfy the interest obligation, they may face bankruptcy. The company should pay down debt in order to strengthen its debt to equity ratio.
My name is AUNI NAJWA and I will explain about profitability ratio. Profitability ratio measures how effectively the firm uses its asset to make profits. The first one is gross profit margin. Gross profit margin shows the percentage of sales remaining after deducting the cost of making such sales. Gross profit margin is gross profit divided by sales times 100%, which is 7,200,000 divided by 17 million and times with 100% equals to 42.35%. Industry average is 38% and this shows that Hikmah Bati Berhad gross profit margin is greater than the industry average, so that the company's sales activities should be prioritized in order to improve this ratio. Following that, the company should expand into other markets. It has the power to revolutionize a business and when used appropriately, it may significantly enhance the company's profitability. The second one is operating profit margin. Operating profit margin is derived after deducting all costs and expenses, excluding interest charge and taxes from the sales figure. Operating profit margin is earning before interest and tax divided by sales and then times with 100%, which is 2,400,000 divided by 17 million times with 100% equals to 14.12%. The industry average is 18% and this shows that Hikmah Bati Berhad operating profit margins is lower compared to industry average. To increase operating profit margins, the company should minimize the cost of goods supplied by working with their suppliers. Aside from that, the company's inventory management might be improved. The third one is net profit margin. The net profit margins will indicate the pricing strategies adopted by the firm. These ratios also measure how much net income generated as a percentage of revenue received. The formula for net profit margin is net income available to common stockholders divided by sales times 100%, which is 1,390,000 divided by 70 million times 100% equals to 8.18%. The industry average is 8% and this shows that Hikmah Bati Berhad net profit margin is higher than industry average, so that the companies may improve their net margin by increasing revenue such as selling more products or service. Aside from that, the company may raise their net margins by cutting costs such as locating cheaper raw material suppliers. The next one is return of assets. Returns of asset indicates the management's ability to make profit from the firm's investment in assets. The formula for return for asset is net income available to common stockholders divided by total assets, which is 1,390,000 divided by 11,200,000 times with 100% equals to 12.41%. The industry average is 12% and this shows that Hikmah Bati Berhad returns of asset is higher than industry average. To improve asset return, the company should raise net income. There are several ways for a company to boost its net income. As example, the company might raise overall sales for the time, resulting in an increase in net income. Aside from that, increase the efficiency of current assets. The efficiency which these assets are used may allow them to be kept low or create additional cash. The last one is return on equity. Return on equity is to measure the profit earned by the common stockholders from their investment in the company. The formula for return of equity is net income available to common stockholders divided by common equity times with 100%, which is 1,390,000 divided by 5,800,000 times 100% equals to 23.97%. The industry average is 20% and this shows that Hikmah Bati Berhad returns of equity is higher than industry average. Therefore, more financial leverage should be used by the company to enhance its returns on equity. Also, boosting profit relative to equity can improve a company's return on equity.
Alright, I will continue with marketability ratio. Market ratio are also called investor ratio. They relate a firm's stock price to its earning and book value per share. They also give the management an indication of what investors think of the company's past performance and future prospect, as well as measure the investor perception and judgment toward the firm's growth potential. earning per share concerning about common stock and mainly used by public companies. It indicates the profit earned per unit of issued share. Formula for earning per share is net income available to common stockholder divided by number of ordinary shares issued, which is 1,530,000 minus 140,000 divided by 4 million equal to 35 cents per share. This means that Hikmah Bakti Berhad earning per share is higher than industry average. Repurchase their own share is one of the ways to improve the ratio. Price earning ratio compare the current market price with earning to establish whether the stock is overvalued or undervalued. Formula for price earning ratio is share price divided by earning per share, which is 3.40 divided by 0.35 equal to 9.71 times. We can see that price earning ratio in Hikmah Bakti Berhad is higher than industry average. To improve the ratio, a combination of economic growth and low inflation. Dividend yield compare the dividend per share received by the shareholder with the current market share price. Formula for dividend yield is dividend per share divided by market price per share multiplied 100, which is 0.15 divided by 3.40 multiplied 100 equal to 4.41%. It means that Hikmah Bakti Berhad dividend yield is lower than industry average and they need to increase its payout or its share price fall and conversely to improve the ratio. Dividend per share is a measure of the dividend payout per share of a company's common stock. It is used to estimate the number of dividend that an income investor might expect to receive. Formula for dividend per share is ordinary dividend divided by number of ordinary shares issued, which is 600,000 divided by 4 million equal to 15 cents. This shows that Hikmah Bakti Berhad dividend per share is higher than industry average. Ways to improve the ratio is a rise in net earning of the company and a shift in its growth strategy. Dividend payout ratio is a total amount of dividend payout to shareholder relative to the net income of the company. Formula for dividend payout ratio is dividend per share divided by earning per share, which is 0.15% divided by 0.35% equal to 0.43%. It shows that Hikmah Bakti Berhad dividend payout ratio is higher than industry average. To improve the ratio, the company might raise net earning from which dividend are paid.